Good morning, students. My name is Sunil Kumar, PPT Accountancy in Cambridge International School, Dasuya. Dear students, today we are going to do chapter number 6, Accounting Procedure, Rules for Debit and Credit. But before starting the chapter, we have to recapitulate what we have done in the previous class. In the previous class, we have done accounting equation. In accounting equation chapter, there are three major terms which we need to understand and which we have already done. Just we are going to recapitulate all those terms. Number one item is income. Incomes are divided into three types of income, that is income earned and received. Its effect on accounting equation is it will increase the cash and increase the capital simultaneously. Number two, income earned but not received. Income earned but not received means it's an asset. So it will increase your assets and increase your liabilities simultaneously. Number three, income received but not earned. It means you have received some amount of income, but for that income you have done nothing. You did nothing for that income. So what will be the effect in the accounting equation? It will increase your cash and increase your liability as well. So this is the three items or three cases of incomes. Now expenses also have three cases. Number one, expenses paid. It is an expense, so it will decrease your cash and decrease your capital as well. Second, expenses outstanding. Outstanding means due but not paid. So expenses are due but you have not paid those expenses. So it is your liability. It will increase your liability and decrease your capital. Number three, expenses prepaid. Expenses prepaid means assets. You have not taken any services but you have paid the amount for the future, so that in future you will get the services from the organization. So you have already paid the expenses but did not get any service against it. It is your asset, so it will decrease your cash but at the same time increase your assets. There are three special cases. Number one, interest on capital. Interest on capital is first added with the capital and then deducted from the capital. Ultimately, it will not affect your accounting equation because once it is added, another time it is deducted, so the effect is zero. Second, interest on drawings. Interest on drawings are also the same, first added with the capital, then deducted from the capital. It will have zero effect on the accounting equation. Depreciation. Depreciation will decrease the value of assets, so decrease in assets and decrease in capital. Depreciation is sort of loss, so it that is why it is decreasing the capital also. So these are the three items which we have studied in the previous classes and previous chapter. So hope you understand everything about the previous chapter. Today we are going to do chapter number 6, Accounting Procedures, Rules of Debit and Credit. In this chapter, we would enable to understand the meaning of account, meaning of debit and credit, rules of debit and credit, classification of accounts. So these four things we are going to study in this chapter. First, we are going to do account. What is an account? Account is a summarized record of transactions at one place relating to a particular head. It means all the transactions which we do in day to day, those transactions are recorded in journal, and from journal they are transferred to the particular account in which they are summarized, and they will be total over there so that we can exactly know what is the total expense or income in that account. Second, it is divided into two parts, that is debit and credit. It is usually in T shape. Next, meaning of debit and credit. Debit means it refers to the left hand side of an account. In abbreviation form, debit is written as DR. An item recorded on the debit side of an account is said to be debited to the account. If you are going to record any item on the debit side of an account, it will be said the item is debited to the account. Debit is simply addition to an account. You can say that whenever you are writing any item on the debit side, it means it is added within the account. Credit. Credit refers to the right hand side of an account. In abbreviation form, credit is written as CR. An item recorded on credit side of an account is said to be credited to the account. Credit is simply subtraction from an account. It means when you record any item on the credit side, it is uh, it is said that something or some items has been deducted, or it is uh, gone out of the business. So it is here is the meaning of debit and credit. Hope you all understand the meaning of debit and credit. Here is the graphical presentation of debit of an account and the debit and credit. Accounts looks like a T shape. If you are looking at the account, it is a T shape account. The left hand side of an account is the debit side, where you record all incoming items as per the definition. And on the credit side, which is of right hand side, you are recording any item which is recorded on the credit side is called item is credited on credit side, and it is outgoing from the business. So this is the account, how it looks like. Here are the rules for debit and credit. Under double entry system of accounting, each transaction has two aspects. One aspect is debit aspect, that is receiving or incoming aspect. Second aspect is credit aspect, that is giving or outgoing aspect. Therefore, debit and credit aspect of a transaction form the basis of double entry system. It is very rightly said by Luca Pacioli, developer of double entry accounting. He said, double entry accounting is based on a simple concept. Each party in a business transaction will receive something and give something in return. In bookkeeping terms, what is received is debit and what is given is credit. The T account is the representation of a scale or balance. If you see the diagram, T-shaped account, left hand side is the receiving side, that is debit side, and right hand side is the giving side, which is credit side. Luca Pacioli is the father of accounting. Here is the classification of accounts. Accounts are classified into traditional concept and modern concept, or we can say traditional approach and modern approach. Here we are going to do traditional approach. According to the traditional approach, accounts are divided into two parts: personal account and impersonal account. Here the personal account further divided into three types of persons. Number one is natural person. Number two is an artificial person. Number three is representative person. If you look at the impersonal side, there are two types of impersonal accounts. Number one is real account, and number two is nominal account, which deals with revenue and expenses. One by one, we will see each and every account in detail. So let's start. Begins with the first natural personal account. It means person created by God. Therefore, these will include accounts in individual name. For example, Radha's account, Mohan's account, Arnood's account, Simran's account, etc. In natural person, we record only the creation of God or the man or the human being which is created by God, and every human being has some name. So we record all the transaction which is related to natural person in the accounts. Second is artificial person. Artificial person is actually is a person in the eyes of law. Artificial person is a person in the eyes of law. Now, these accounts include accounts of corporate bodies like Reliance Industry, uh, Tata Industry, big industries, or institutions which are recognized as persons in business dealings. For example, accounts of college, schools, limited companies, shops, etc. These are an artificial person. Any building which is having a name is an artificial person, whether it's a small business, small school, big school, colleges, universities, hospitals, banks. These are the examples of an artificial person. Third one is representative personal account. These are accounts which represent a certain person or a group of persons. It includes outstanding expenses, it means expenses due but not paid. Prepaid incomes, it means incomes earned earlier before time. Income received in advance, this is also the income which you received in advance, you have not done anything for this. And accrued income means income due but not received. You have to receive, you have done the work, but you have still not received the income. Here it's a prepaid expenses. Prepaid expenses mean you have already paid the expense in advance, and the services of that uh, payment has not been taken by you. So it's an asset. Also, we can say that it is an asset. But here, uh, if out of these four terms, any terms is added with any expenses or income, it becomes a representative person. Now these are outstanding, prepaid, received in advance, accrued, etc. So these are the four terms. When it added with any income or expense, it becomes a representative person. Like for example, outstanding rent, prepaid salary, commission received in advance, accrued rent. These are few of the examples. So this is representative person. So we have read three person: natural person, artificial person, and representative person. Now rule for the personal account is debit the receiver, credit the giver. The person who receives will be debited and the person who gets will be credited. Now we are going to study about impersonal account. Impersonal account can be classified into two categories. Number one is real account. These accounts relate to tangible and intangible assets of the business, excluding debtors. Debtors are not included in real account because it is treated as a person. Examples of tangible assets are land, building, plant, machinery, stock, cash in hand, etc. Examples of intangible assets are goodwill, patents, trademarks, etc. Rule for debit and credit for real account is debit what comes in, credit what goes out. Second one is nominal account. Nominal account normally covers all expenses and losses, incomes and gains. So these account relates to expenses, losses, gains and revenue. Revenue, that is your income, are termed as nominal account. The result of this account is profit or loss, which is transferred to the capital account. When we use this account rule, whatever the result come, that is all expenses and losses, all incomes and gains, whatever the difference will come, that will be maybe the profit or the loss, and whatever the result is, profit or loss, it will be added with the capital. Now the rule for debit and credit for nominal account are as follow. Debit all expenses and losses, credit all incomes and gains. So whatever the expenses and losses, we will debit, all incomes and gains will be credited. So here we are going to do one question on the basis of traditional approach. In traditional approach, we will apply three things, three formulas, that is real account, personal account and nominal account. Real accounts rule is debit what comes in, credit what goes out. Personal accounts rule is debit the receiver, credit the giver. And nominal accounts rule is all expenses and losses debit, all incomes and gains credit. So these are the rules which we are going to apply in this question. So let's start the question. By applying the traditional approach, analyze the following transactions. Number 1, Asha started business with cash. Number 2, purchased furniture for cash. Number 3, purchased goods on credit. Number 4, goods to current, sold goods to current for cash. Number 5, sold goods to Sham on credit. Number 6, cash received from Sham. So let's see the solution, how we will solve this. We will draw 5 lines. In the first column, we will write transactions. Second, accounts involved. Third, nature of account. Fourth, rule applied. And the fifth one is the explanation, where we will write um, uh, the character of the real, personal or nominal accounts. So number 1 transaction is Asha started business with cash. Here we will find that cash accounts which are involved in it, cash and Asha's capital. Cash is coming in the business and Asha has given the capital, that is amount, to the business. So in the previous chapter we had learned that when the owner invest uh, something in the business, that is called capital. So here the Asha has invested cash in the business, so it is Asha's capital. So we found that there are two accounts involved in the transaction, that is cash and capital. Now nature of account, cash is an asset and capital is Asha's capital, so natural person. Asha is a natural person, so amount is invested by Asha, so it's natural person. Rule applied is for assets, real account, for person, personal account. Explanation is real account what comes in, debit, and personal account credit the giver. So hope you understand the first transaction, how we have solved this transaction. Now number 2, purchased furniture for cash. Now here we have to identify the transactions, what accounts are involved. So furniture we have purchased and against the furniture we paid cash. So we found two accounts, furniture and cash, involved in the transaction. Furniture is an asset, cash is also an asset. So both are real account. The rule applied is real account and the explanation is what comes in, debit for furniture, and cash is going out. So what goes out, credit. Hope you all understand this point also. Number 3, purchase goods on credit. Earlier we purchased furniture. Furniture is an asset. Now we are going to purchase goods. Goods is something which we purchase for sale, but for assets we do not purchase for sale. So here goods. In accounts, goods is written as either purchases or sales. So here we purchased goods, so we are writing purchases. And these goods are purchased on credit, so credit is created from the person from whom we have bought these goods is a creditor. So two accounts we have found, purchases and creditor. Nature of account is purchases is your expenses and creditors is a person. So rule applied is for expenses nominal account, for person personal account. Nominal account debit all expenses and losses. So purchases is debited. Personal account is credited here to credit the giver. So the creditor is a person who gave us the goods. So credit the giver. Number 4, sold goods to current for cash. Here we will see that we are selling goods and getting cash. So we easily found out two accounts, that is cash and sales. Cash is an asset, so nature of account is asset. Sales is a revenue, the nature of account is revenue. For assets, real accounts rule, what comes in debit will be applied. For revenue, that is your income, nominal account will be applied, credit all incomes and gains, because when you sell goods, you will earn something, you will get some income. So that is credit all incomes and gains. Number 5, sold goods to Sham on credit. Now, in the fourth transaction, we sold goods for cash. When we sold goods, we were getting cash. Now, in transaction number 5, we sold goods, but we are not getting anything. So, here is a new account will be created. The person to whom we have sold the goods is our debtor. Debtor means the person from whom we have to take money in future. So Sham is debited and sales credited. Sham is a person, personal account will be applied, debit the receiver. Here the Sham has received goods from us, so he is the receiver. Sales, sales gives us revenue, it's nominal account, credit all incomes and gains. Number 6, cash received from Sham. So here Sham is paying us what goods he bought from us. So cash account and Sham's account. We have found two accounts that is involved. Cash is coming in the business. Who is paying this cash? That is Sham. So cash is an asset. Sham is a person. Rule applied here is for cash real account, for Sham personal account. Real account, what comes in debit? So cash is coming. That is why cash is debited. Personal account, credit the giver. So Sham is creditor here. So this completes our question. Hope you understand what we have done. We will provide you a worksheet also so that you can do these types of questions and practice at home so that you become a good uh, in your subject accountancy. So with this question, we have finished with the traditional rules. Now in the next class, we will start modern rules. Till then, stay safe, stay healthy, and stay at home. Thank you.